Meantime, to say today's Fed announcement at 2:15 is anticipated is an understatement. Everyone is going to be watching to see what Fed Chairman Ben Bernanke might do. Our next guest is one of Bernanke's critics. He's warning that more quantitative easing won't save the economy. It might actually harm it. I'm talking, of course, about Jim Grant of Grant's Interest Rate Observer, one of the most widely read newsletters on Wall Street. And I know Jim was warning about the housing bubble as early as 2002. So obviously
before there was one.
Before there was one. So a lot of interest in what you're seeing out there now as risks. But like, just set the setting for me here. I mean, you're a skeptic about quantitative easing, period.
Well, I think the way to think about it, Margaret, is to observe the economy is not measuring up, and the Fed is going to change the ruler. That's what this boils down to. I think the important thing to begin with is to speak more plainly and to lift this semantic fog the Fed is only too happy for us to participate in. They talk about quantitative easing or long-term asset accumulation. No, it is money printing. And what they intend to do is to generate a cheaper dollar, otherwise known in the trade as a debased dollar, and with this inflationary dollar to make everything seem better. That is the agenda.
Well, a weaker dollar will theoretically, right, help exports, except for everyone else trying to push their currencies down into other markets. And, you know, someone like a Mark Zandi was just on the show would say it'll also help out with mortgage rates.
Someone will gain. One of the difficulties is that the dollar is truly the world's currency. More than half of the greenbacks in circulation change hands outside the 50 states. A good portion of our tradable public debt is on the balance sheets of our creditor central banks. So while the dollar is the world's currency, the Federal Reserve is America's central bank, America's and only America's. And it seems to have no appreciation of this terrific franchise that the dollar has. The dollar is the Coca-Cola of world monetary brands. It is a great asset. It's probably America's greatest export. And the Fed is in the business of making dollars much more plentiful, where most of the world is no thank you, we have enough of them. So the Fed is running a great risk, I think, in cheapening the dollar, as it is evidently intent on doing.
Well, when you talk to political watchers, those who keep their eye on what might be happening on the fiscal front, they say there's not a whole lot to expect, particularly with gridlock in Washington. That puts the weight of jumpstarting the economy even more so on the Fed. So what tools should the Fed be using, if not QE?
Fewer. What I would like from the Fed is less. I would like it to recede from the business itself. Its self-accumulated roles of manipulator of asset prices and of economic planner. The art of central banking over the years and generations has quietly morphed into that of central planning. The Fed really is out of its lane. Its original remit was to provide liquidity to the economy in times of cyclical and seasonal stress, and lo and behold is now telling us what assets to buy, at what prices, and what level of nominal GDP we should all need. I mean, I think it's an extraordinary example of mission creep.
Do you see the danger of asset bubbles out there as a result?
Absolutely.
Where are you finding
it? Well, you see it all over the place. In the most fertile, for example, in the most fertile black earth counties of Iowa, farmland is trading, in some cases, over $9,000 an acre, which is great for the farmer doing the selling. It might be good for a while for the farmer doing the buying, but these are levels that we have not seen before. Rental yields on farmland nationally are at 40-year lows. So from the black earth of the Midwest to Wall Street and places in between, stocks, bonds, land, what have you, are rising to levels that may or may not be sustainable. And when these bull markets burst, people should write nasty letters to Ben Bernanke personally, because he will have a great responsibility for what's happening now.
Is it repeating the errors of an Alan Greenspan, someone you have been a critic of in the past as well?
Yes, yes. What the Fed is doing is arrogating to itself the business of telling us all what valuations we should expect on assets, because the Fed is now in the business of manipulating interest rates and printing money, all to the end of lifting the economy through the mechanism of lifting asset prices. It's very dangerous stuff.
We're back now with Jim Grant, editor of Grant's Interest Rate Observer, author as well of Mr. Market Miscalculates the Bubble Years and beyond. Jim, it's always great to have you here in studio. I know you've been a skeptic of QE and these expectations that the Fed will go out and purchase 100 billion, 500 billion of assets this afternoon. Talk to me about one of the fears out there, and that is deflation.
Right. Deflation is that state of affairs in which prices sink rather than rise. It's what Americans are on the prowl for most weekends, everyday low and lower prices. In fact, is the Walmart business model. What the Fed has not done is to persuade us all that this thing is such a great peril, this thing they call deflation. In fact, speaking to a World Series theme, Margaret, the last time the Giants won the World Series was 1954. And in September 54 till August of 55, for 12 consecutive months, the CPI showed negative year-over-year results. It printed negative for a full year. The Fed was cautionary with respect to its rhetoric about this development, but not panicked. In fact, the federal funds rate went up from about 1/3 of 1% to 2% while prices were registering these declines. Stock market rallied, commodity prices rallied. The world turned. What is interesting now and telling is that the prospect, not the thing, but the prospect of everyday low and lower prices has the Fed in a state of panic. It wants us to panic too. It wants us to climb out in the yield curve and buy the Treasury's best.
Well, that's Bernanke's history as a student of the Great Depression, right? That's leading that? Well,
some of us have read about the Great Depression and arrived at different conclusions. It's not as if by having written or contributed to one book, one is there as a license to go out and print $500 billion worth of currencies on any given Wednesday.
You have such a great way of putting things there, Jim.
And besides, you know, America's creditor nations in Asia are raising their interest rates because
on expectation that they're going to see further easing. Here we saw India do it, we saw China do it, we saw Australia as well. So give me that. I mean, isn't that something that's fundamentally changed about the environment when you compare it to the history?
Yes, many things have changed. And you know what else has changed is that the banking system has become, of course, much more levered. The Fed by itself, by the way, is now highly levered. But the banking system has become much more levered and much less liquid. And perhaps Bernanke is reasoning that there is much less capacity to absorb falling prices in the financial structure. So precarious as this one.
All right. Well, Jim, we have to leave it there as it's finishing out the hour for us. We move into the second hour right now. Thank you for coming in.
You are welcome, Margaret. Nice to see you.
Nice to see you.